Something massive could hit gold and silver this week, and most investors won't realize it until the move is already underway. Federal Open Market Committee week is here, and markets are entering it with tension, confusion, and fragile expectations. Gold is sitting near the $4,700 zone after a sharp weekly pullback. Silver is hovering around the mid-minus $70s after a deeper decline. Both metals are now positioned to trigger a violent reversal or another leg lower. And there's one signal almost nobody is watching that may reveal the next major trend before headlines catch up. We'll get to that shortly. Most people think FOMC week is only about one thing. Will rates be cut, raised, or held steady? But experienced traders know that is the surface level story. The deeper story is expectations do not move on decisions alone. They move on the gap between what was expected and what was delivered. Right now, many investors believe the Fed will likely hold rates steady. That part may already be priced in. The real danger and the real opportunity is hidden in the language. One sentence about inflation staying sticky can hit gold instantly. One hint that cuts are delayed can pressure silver hard. One phrase suggesting economic weakness could send both metals sharply higher. That is why this week matters far more than many realize. Here's what nobody sees. Gold has pulled back toward the $4,680 to $4,700 support region, but it has not collapsed. That resilience matters. Markets often test conviction before a major move begins. If gold were truly weak, many argue it should already be much lower after recent dollar strength and rising yields. But it is still standing near historically elevated territory. That tells us buyers may still be underneath the market. Who could those buyers be? Central banks, long-term allocators, wealth preservation investors, and institutions hedging against policy mistakes. Many countries have continued adding gold reserves in 2026, with Poland among the notable buyers. That is not emotional money, that is strategic money. But silver tells a different story. Silver has dropped harder than gold and remains more volatile. That often happens because silver carries both monetary demand and industrial demand. If markets fear slower growth, silver can get hit faster than gold. But that same volatility can reverse violently if sentiment changes. And that is where opportunity may be building now. Silver near $75 to $76 has become an important zone. If it stabilizes and reclaims higher levels, traders may quickly start targeting $78 and beyond. If it loses support, pressure could extend towards $74. But this matters more. Silver is not just reacting to macro fears. There is still a structural supply deficit story in the background, and strong physical demand from Asia has remained notable. Reports of record imports from China added to that narrative recently. So while traders focus on charts and Fed headlines, a deeper supply-demand story may still be building quietly underneath. That contrast is powerful. Weak price action on the surface, strong physical demand underneath. Those are the kinds of disconnects that sometimes create explosive reversals. Now let's talk about the dollar. The US dollar remains one of the most important forces for metals this week. If the Fed sounds hawkish, the dollar could strengthen further. That would usually pressure gold and silver in the short term. But if the Fed sounds cautious or signals future easing, the dollar could soften. That would remove one of the biggest headwinds metals have faced recently. This is why many professionals watch the dollar reaction before they even look at gold charts, because sometimes the metal move starts in currencies first. Now look deeper. Bond yields may matter just as much. If treasury yields rise after the meeting, gold may struggle initially because higher yields can make non-yielding assets less attractive. If yields fall because markets smell slower growth or future cuts, gold could catch a powerful bid. This is where beginners often get lost. They think gold only trades on inflation. It does not. Gold trades on real rates, trust, liquidity, fear, and opportunity cost. Silver trades on all of that, plus industrial demand. That complexity is why sudden moves can surprise people. Now, let's address the emotional side of the market. Many retail investors are nervous right now. They saw gold near highs recently. They saw silver rally sharply earlier. Now both have pulled back into FOMC week. That creates doubt. Was the rally over? Was it a trap? Should they wait? Should they buy? That confusion is normal. And markets often create maximum confusion right before a large directional move. Because uncertainty shakes out weak hands, here's the signal. When everyone feels comfortable, opportunity is usually smaller. When everyone feels uncertain, opportunity can become larger. That does not guarantee upside, but it explains why major turning points often feel uncomfortable in real time. Now we are reaching the midpoint of this story, and what gold and silver do in the first 15 minutes after the Fed may reveal the next 3-month trend. If gold spikes above $4,750 and holds gains, markets may be signaling renewed confidence in higher prices. If gold sells off quickly but snaps back, that can indicate hidden demand absorbing weakness. If silver instantly outperforms gold and pushes back towards $77 to $78, it may signal risk appetite returning to metals. If silver lags badly while gold rises, markets may be favoring safety over growth. That difference matters enormously because gold leading alone can be defensive. Silver joining the move can be expansionary. And when both move together, the trend can become powerful. But there's another layer. Mining stocks may confirm the truth before spot prices do. If gold rises, but miners remain weak, skepticism may still dominate. If miners rally strongly with metals, confidence may be returning fast. Many experienced traders watch miners as a lie detector for gold rallies. Now, let's discuss 3 realistic scenarios for this week. Scenario 1, the Fed holds rates and sounds dovish. Officials acknowledge slowing growth, easing inflation pressures, or rising downside risks. Gold could rebound toward $4,800 and potentially challenge higher resistance. Silver could reclaim $78 and start building momentum toward the low dollar ADS. Scenario 2, the Fed holds and sounds neutral. They repeat patience, data dependence, and caution. Markets may whip in both directions. Gold could remain range-bound between $4,680 and $4,750. Silver could chop between $74 and $77 while traders wait for the next catalyst. Scenario 3, the Fed holds and sounds hawkish. They emphasize sticky inflation, delayed cuts, and resilience in the economy. Gold could retest lower support zones near $4,600. Silver could see sharper pressure because of its higher beta nature, possibly testing $72 to $74. But here's what nobody sees. Even a hawkish reaction could become bullish later if markets decide tighter policy will slow growth too much. That is why first reactions are not always final reactions. Sometimes algorithms trade the headline. Humans trade the meaning afterward. Now, let's talk about the bigger picture. Why are central banks still buying gold, while many retail traders hesitate? Because central banks think in years, not hours. They care about reserve diversification, currency risk, geopolitical fragmentation, and long-term purchasing power. Retail traders often care about this week's candle. That difference in time horizon changes everything. Now consider silver again. Silver may be one of the most misunderstood assets in markets. It can behave like gold during fear. It can behave like an industrial metal during growth optimism. It can underperform for months, then outperform in weeks. That is why silver often punishes impatience and rewards timing. But this matters more. If silver breaks above $78 after the Fed and holds there, many traders may suddenly start talking about $80 to $82 again. Momentum attention can return quickly once levels break. And if it fails near resistance again, disappointment can hit just as fast. That is the nature of silver. Fast upside, fast downside, high emotion. Now let's close the loop from the beginning. Why could FOMC week trigger a massive gold and silver move next? Because markets are entering this meeting already divided. Inflation is still a concern. Growth signals are mixed. The dollar has been firm. Yields remain elevated. Gold is near critical support. Silver is near critical sentiment levels. That means expectations are fragile, and fragile expectations can break violently when new information arrives. If the Fed sounds softer than expected, metals could rebound sharply. If the Fed sounds tougher than expected, metals could fall first. If the Fed sounds uncertain, gold may interpret that as fuel for the months ahead. Either way, volatility could be far larger than most expect. And when markets underestimate volatility, opportunity often follows. So what do you think happens first? Gold rebounds toward $4,800, or silver shocks everyone and races back above $78? Let me know in the comments. And if you want sharp, high-level market analysis before the crowd catches on, subscribe and stay close to the signal.